what you and I talk about every week is, the different type of risks as we're analyzing these deals. And what I wanted people to understand is when we look at a deal to buy, we don't just analyze the deal, we break it into 3 different tiers of risk. The most risky type of deal is something that's built, new, kind of like that guy at lunch was talking about, oh, it's new, it's built, it's already there. Well, we don't want that because the only way there's upside is if the market continues to do this. Correct. It's actually, in a way, it's actually a little more risky. It is. It's the most risky way to achieve upside.
Yeah.
Because you're 100% dependent on the market.
That's right.
And, Grant Cardone says, go buy A class.
Right.
Because it's less work. He doesn't want to deal with the rehab. Well, I don't want to buy what Grant Cardone buys.
Correct.
I want the lower risk.
Right.
I want the tax write-offs that comes with renovating units and value-add strategies. And so the 2 risk tiers that we do like, we love appreciation, don't get me wrong.
Of course, and we expect to get it.
Yeah. The number 2 risk tier for us is appreciation and upside through value-add.
Well, the number 1 way, without question, to raise rents is through a value-add deal. Mm-hmm. As long as you're in the market, as long as it's a great location, as long as you bought it right, which of course we will, you're going to make more money in value add than anything else, hands down. And not everybody wants to move to Florida or Arizona.
It's true.
And God bless, we'd love to buy something in Arizona or Florida, but because it's become so popular, it's been hard to find stuff that makes sense. So when you find something that makes sense in an incredible submarket like Cleveland Heights, it's just a no-brainer.
Absolutely. So we have a value add plan. We have 1.5 set aside, about $10,000 a door.
Yep.
Plus an additional contingency fund of $750,000 for inflation.
Right.
So that's tier 2 risk is upside through renovations. The number 1 thing we look for is, okay, that's great. We are always going to do value add. But is there upside without doing renovations?
Right.
And what's the answer? Of course.
Of course there is.
So we've already proven the business model. Jason just got done telling us that we were renting one of our units that we bought in December from the Fairmont portfolio. We were renting that one for $1,100.
Right.
He had a doctor and her husband was an online marketer.
Yep.
2 working business people needed to move in, and they're paying $1,800 now.
Right.
Without lifting a finger.
Right.
Without us spending that money that we had set aside to spend.
Right.
And so when we evaluate deals, if we're only relying on value add and market appreciation, well, maybe it's a really good value add play.
Sure.
And that's great. But every deal we've bought together so far had upside without lifting a finger.
So far.
And had additional upside through renovations.
Right.
And of course, we love upside through appreciation.
Absolutely.
So, when our investors are analyzing deals, there's other groups other than us buying multifamily.
Of course.
Pitching deals.
Right.
That's what I wanted to educate them on is look at what kind of upside there is.
Right.
And are they fudging the numbers? Or are they okay with much, much more risk? We're simply not. We're in this for the long game, right? I'm not interested in making a quick buck. I'm not interested in taking high risk, and neither are you.
It's not that complicated. The average rent in the portfolios are $600 to $700 a month for the units. Mm-hmm. Market is $1,100 to $1,200. Mm-hmm. The delta is the fat, is where we make the money. That's the key to all the transactions that we do. And when you have a combination of one of the best submarkets in the country, you have an incredible team on the ground. You're buying it at $70,000 a door, which we will be buying it for. And then you have this huge delta in rents. Then that's the kind of combination we just say, how can we get in contract this? How can we tie it up?
Absolutely.
Yeah.
One other thing I wanted to touch on that's really important is there's 3 things that we look for on every single deal. And when we talk about risk and when we talk about these different things that we look at or look for, we always go back to the 2008 recession. The name of my podcast is Recession-Proof Real Estate Investing.
Right.
Because making money is great, but the number 1 rule about investing is never lose money.
Right.
And so we look at different things, and the first thing we look at is, can a property cash flow as is and make it through a recession?
Right.
Or is it dependent on us spending a huge amount of money and having to throw a lot of money into it?
Right.
And we always look at a property, we look at the P&L, we extrapolate the numbers, and we look at this property and we recession test it, or we stress test it.
Right.
So this property that we have under contract, at 20-30% vacancy, 35% vacancy, it still cash flows.
Right.
Without doing the value add.
Right.
And the last thing we want to do is spend a bunch of money on a property, have some type of recession come,
Yep.
and have to tell our investors, well, we can't pay the bills.
Right.
Because there are operators that has happened to, and that will happen in the next recession. And guess who's going to be buying those properties?
Can't wait.
Yeah.
Let me know when that happens.
Yeah. So cash flow is king. In any recession, cash flow has to be king. There has to be enough wiggle room.
Yes.
There has to be a comfort margin. I want to be able to sleep at night.
Right.
During the next recession. And I want to be ready to take advantage of the next recession. You can't do that if you're barely paying the bills, barely making it through on your other properties. If your other properties are cash flowing, guess what? You can buy John Doe's property, who he paid too much for.
That's right.
And that's the goal. So that's number one, is cash flow, and cash flow through any type of recession that may come. Luckily, we have 2008 recession to look at. We know how bad it got. We add some wiggle room on top of that. If we can still cash flow that deal, then we buy that deal.
Well, and don't forget, we just are coming out of a pandemic.
Yep.
And there were a few operators that we know, well-regarded people that had a challenging time during the pandemic. We don't want to be those people.
Well, and that was my favorite part of the pandemic. I don't want anyone to struggle.
Right.
But it made us look really good.
Right.
It proved our underwriting principles. It proved that, hey, it's actually, instead of advertising this sexy deal,
right,
how about you advertise that you're smart and conservative?
Right.
And maybe we should buy those deals.
And didn't have to suspend distributions.
We didn't have to ask for forbearance on our loans.
Right. That's right. Oh, God forbid.
That's just, you didn't have a capital call. We've never had a capital call.
No.
There are things that investors should be looking at that I think they get stuck on high returns.
Yes.
And high, promises from operators.
That's right.
We promise less, deliver more, and we deliver lower risk.
Correct.
So the number two thing we look at is appreciation. And this is why we don't go to tertiary markets.
Right.
We don't go to markets where you can get a 8, 9, 10 cap rate.
Yep.
But it's because they have one employer in town. It's a one-horse town.
Right.
It's going to be hard to find. I mean, there's so many reasons we don't go to tertiary market, but the number one reason is it's going to be hard to find good help, and the appreciation just isn't going to be there.
Or it's a major metropolitan market, but you have to collect the rent with a gun. We're not going to do that.
And you're not going to have appreciation in that type of location either.
No.
So Cleveland is a fantastic market.
Yeah.
We've chosen the best sub-market of Cleveland.
Right.
And the appreciation is there because of the Cleveland Clinic, because of the job base, because of the tenant base. So the appreciation.
Don't forget the law school.
And the law school. Yeah, the law school. So those are the first two things we look for. And when a property has the cash flow, it's in the right location, it's going to appreciate, we also want tax write-offs. That's why we don't buy the A-class.
Right.
We're going to throw money into renovations, and we're going to cost segregate that property and have a combination of cost segregation, value add money spent, and have a fantastic tax write-off. Right now we're averaging 40 to 50% of the money you invest in a deal comes back to you as a loss on a K1.
Right.
That's hard to beat. I mean, go buy some Bitcoin and tell me how many tax write-offs you get. Go invest in the stock market. How many tax write-offs do you get?
Or Rolexes or art.
Yeah, or Rolexes or art, or cars.
Or cars.
Yeah, I don't know. So it's already our deals are cash flowing 5 to 8, 10% per year.
Yep.
Average returns are 15% plus. But then you take this magic thing called depreciation and you throw it into the returns. Returns are over 18% easily, depending on your tax bracket and your passive income and losses. So, I mean, for me, this Cleveland Heights property not only, and our other properties for that matter, not only check those boxes, but with flying colors. And that's the only reason we're able to put $500,000 down, non-refundable day one on these properties, because they check those boxes and we know exactly what we're looking for.
And we wouldn't buy it if we didn't.
Exactly.
They have to pass all those. They have to cross all those thresholds, or else we won't buy it.
Yeah, we're not willing to budge on our underwriting principles because we know the market's not always going to be this good.
No.
And while I would love to buy a whole bunch of deals and grow faster than we probably are right now, we're more concerned with stability, long term. What does our portfolio look like in 2 years, but more like 5 years and 10 years?
That's right.
And what is our track record going to be?
Correct.
So, there's a famous investor that said, I don't want you to judge me by my winners. I want you to judge me by my losers, because there's so few.
Right.
And that is much more important, because a lot of operators say, well, look what we did over here, but don't look at these other properties that we failed on and our investors lost money.
Right.
I've never lost money investing.
Neither have I. So we don't want this to be the first.